Today, we're diving into Hedera, HBAR USDC, where the chart is showing signs that the current bearish cycle might soon be nearing exhaustion. On the daily Heikin-Ashi chart, HBAR remains within a clearly defined downward-sloping regression channel, indicating a persistent bearish trend. Price is hugging the lower boundary of this channel, a common signal of oversold pressure and possible short-term rebound potential. The Lindsey Trident indicator, which is one of our predictive models, is still confirming a bearish mode, aligning with the adaptive SuperTrend's red confirmation. However, it's important to note that the Trident often detects turning points slightly ahead of price action, meaning we could soon see early stabilization if momentum begins to shift. Looking next at the infinity signal, another predictive indicator, we see the lighter gray line continuing the green line and the darker gray line continuing the red line. These projections are now showing an upward cross forming toward the end of October, a potential precursor to a bullish reversal. Historically, this cross has been a reliable signal of directional change. Meanwhile, the machine learning RSI, which is a lagging indicator, remains deep in the red zone. This reflects heavy bearish sentiment and waning buying momentum. However, the histogram shape is beginning to flatten, a typical early sign of exhaustion within a downtrend. Combining these signals, we're observing a market that's still bearish by trend, but predictive indicators are hinting at an upcoming shift. If the infinity signal's projected cross confirms as expected, HBAR could begin climbing back toward mid-channel resistance, potentially setting up a short-term recovery wave. If the machine learning momentum starts to turn green again, that may be the validation signal for a rebound play. Keep a close eye on the next few candles, because Hedera may be setting up for its first meaningful bounce in weeks.